All right, imagine this for a second. You're running a huge digital company, maybe like an Amazon or a Netflix, right?
Yep.
And you see all this growth potential, not in the usual places like Europe or the US, but, in the global South, Latin America,
Mhm.
Africa, Asia, loads of potential customers, maybe across 40, 50 different countries, young people ready to buy online, but then bam, reality check. Most folks there, they don't have a Visa or a MasterCard that works internationally.
Mhm.
And every single one of those countries has its own way of paying, often cash-based systems, its own tangled mess of financial laws, data rules.
Yeah, it's not simple. Setting up in just one of those countries could mean like 20 different bank contracts,
Right.
setting up a whole local company structure, keeping up with constantly changing regulations. It's designed to stop you before you even start.
An absolute administrative nightmare.
It really is. It's more than just difficult. It's often the reason big companies just don't bother, leaving billions in potential revenue on the table. And that specific chaos, that friction, that's precisely the problem DLocal, ticker DLO, was built to tackle.
Exactly, and that's what we're digging into today. We're going deep on DLocal, this company that basically built an entire business on simplifying that fragmented payment world. We've got a good stack of sources here covering their tech, their business model, the latest financials from Q2 25, and really importantly, their competitive edge.
Right. And our mission today isn't just to list facts. We want to get under the hood, understand how this one DLocal platform actually works. Why do people keep calling it this sticky toll booth for emerging market payments?
Yeah, and what's really driving that massive growth they keep posting?
Yeah.
Let's get into it.
Yeah. Okay, so before DLocal came along, what was the actual situation like? Let's paint that picture of the chaos. You mentioned the payment failures relying on international credit cards just didn't cut it right. Not even close. The sources point to failure rates as high as 50%. Imagine half your potential sales just vanishing because the payment system wasn't set up for cross-border transactions in those markets or because local banks just blocked them.
Half your business
Yeah.
just gone.
Exactly. And that's just the customer side. For the merchant, say, a big U.S. retailer wanting to sell in Brazil or Mexico, the setup was incredibly complex.
Forget just plugging in Stripe like you might in the States.
Absolutely. You needed maybe 20 separate contracts, local banks, local processors, acquirers, different ones for Argentina, Colombia, Chile. Each country was its own silo.
And then the legal hurdles on top of that.
Oh, yeah. You couldn't legally operate without setting up local companies in every single country. That meant dealing with unique licenses, capital controls, different tax rules, different data privacy laws, all while battling those terrible payment approval rates. The sources call it a total mess, and that's probably putting it mildly.
It sounds almost intentionally complex.
In some ways it was. It often protected local players. But that very difficulty, that complexity, became the foundation for DLocal's whole idea.
So tell us about the start. It wasn't a typical Silicon Valley story, was it? It began in Uruguay.
Right, Uruguay. The founder, Sebastian Kanovich, he's an economist. And the story goes, the initial spark wasn't some grand vision of global infrastructure. It was just personal frustration.
Like what?
Like trying to buy an NBA league pass online or just do regular online shopping. He couldn't do it easily without borrowing someone else's internationally accepted credit card. He saw that his own problem was actually, a symptom of a much bigger systemic issue across Latin America.
Interesting. So they started locally first, trying to fix things in LATAM. I read their first big win was tackling Brazil's Boleto system. That sounds archaic.
It kind of was, but it was dominant. The Boleto shows you how deep the cash culture ran. Before DLocal, a customer buying online would get this payment slip, like a barcode on a piece of paper or digitally.
Yeah.
But then they had to physically take that slip maybe days later to a bank or a lottery kiosk or even an ATM and pay it with cash.
Wow. So super inconvenient, and I guess lots of people just didn't bother paying.
Exactly. Huge drop-off rates. And the settlement time for the merchant was incredibly slow, days sometimes. DLocal's early innovation was basically digitizing that whole process. They built a way for merchants to accept Boleto online and get confirmation much faster using local digital connections. It sped everything up, cut fraud, and boosted sales completion.
So they were fixing local problems, but I understand their first attempt at a bigger business model almost didn't work out.
That's right, a crucial pivot point. They first tried launching their own branded product, a direct-to-consumer or B2C prepaid card. It basically failed. It was a distraction. The real breakthrough came from listening to their first big U.S. client, which was GoDaddy.
What did GoDaddy tell them?
The feedback, according to the sources, was pretty blunt. We don't care about your brand. We don't need another card. We just need the plumbing. We need a seamless, reliable way to accept payments across all these different Latin American countries. Make that work.
Ah, so that was the light bulb moment. Forget the consumer brand, become the invisible infrastructure.
Precisely. They realized the massive value wasn't in the B2C space. It was in being the essential B2B provider, the behind-the-scenes engine. That pivot allowed them to stop chasing consumers and focus entirely on building that unified platform to solve the merchant's cross-border nightmare. That's what set them up for global scale.
Okay, so they pivoted to infrastructure. Let's talk about that core solution, the one DLocal platform. How does it actually eliminate all that complexity we just discussed?
It's really elegant conceptually. Instead of a merchant needing, say, 40 different setups for 40 countries, DLocal offers one single point of entry, one API integration, one contract.
That's
One. And through that single connection, the merchant instantly gets access to DLocal's entire network across those 40-plus emerging markets. DLocal has already done the hard work of aggregating over 900 different local payment methods within that network.
900. Can you give us a feel for what kinds of methods that includes? It's not just cards, obviously.
Oh, far from it. In Brazil, you've got the massive instant payment system, Pix plus Boleto still. In Mexico, there's OXXO Pay, where people pay cash at convenience stores for online purchases. You've got crucial bank transfer methods everywhere. Critically, they handle various local installment payment options, super important in places where people buy larger items over time.
Right. Buy now, pay later, but the local versions.
Exactly. And in Africa, they integrate with all sorts of mobile money wallets like M-Pesa, which are often more common than bank accounts. The point is, the global merchant, like an Amazon or Uber or Netflix, they just plug into DLocal and suddenly they can accept all these methods. They're riding on DLocal's pre-built rails and, importantly, DLocal's existing licenses and regulatory compliance in each country.
Okay, makes sense. So how does DLocal make money from this? Transaction fees, I assume.
Primarily, yes. They charge fees on both pay-ins when a customer pays the merchant, and payouts when the merchant needs to pay local suppliers or gig workers, for example. These fees can be a percentage of the value, a fixed fee per transaction, or, significantly, they make money on the foreign exchange, the FX spread.
Ah, the FX spread.
Yeah.
This sounds a bit like how Wise, formerly TransferWise, operates, but maybe in trickier markets.
That's a good comparison. DLocal needs to help merchants move money across borders efficiently. Say a company collected revenue in Brazilian reais but needs to pay salaries in Argentinian pesos. Sending that via traditional bank wires is slow, expensive, and bureaucratic, especially in these regions.
So DLocal bypasses that somehow.
They do, using a system often called multilateral netting. They maintain pools of their own capital in local currency within each country they operate. So they'll have a pool of reais in Brazil, pool of pesos in Argentina, or so on. When that Brazil to Argentina payment needs to happen, they don't actually wire reais out of Brazil. Instead, they debit the reais amount from their Brazilian pool and simultaneously credit the equivalent peso amount from their Argentinian pool to the recipient.
So the money doesn't physically cross borders via the slow banking system.
Exactly. It's much faster, avoids intermediary bank fees, and DLocal handles the currency conversion. They capture the spread between the rate they process internally and the rate the merchant gets. And because FX volatility and, frankly, the cost of alternatives are much higher in emerging markets compared to, say, US dollar to euro, those spreads can be quite significant. It's a high-margin part of the business.
And it's asset light because they're not actually lending or holding customer deposits, just facilitating with their own capital pools.
Correct. No credit risk, no deposit risk, purely transaction enablement.
They also talk about smart routing. What's that about?
That's about optimization. For any given transaction, there might be multiple local banks or processors DLocal could use. Smart routing uses machine learning to analyze the transaction, the amount, the merchant type, the customer's bank, and sends it down the pathway that historically has the highest chance of success, the highest approval rate, and the lowest processing cost for DLocal.
So it helps the merchant make the sale and saves DLocal money.
Win-win. And they keep adding layers to this, like Smart Pix in Brazil, which automates recurring payments via Pix, removing manual steps, or this thing called BNPL Fuse.
Right, the buy now, pay later aggregator. You mentioned installment plans are crucial. Does DLocal take on the risk if the customer doesn't pay their installments?
No, and that's key to their model. BNPL Fuse is basically a platform within a platform. DLocal saw that merchants struggled to integrate all the different local BNPL providers. Fuse lets them plug in once and offer a wide range of local options to their customers.
So DLocal connects them to the local BNPL provider.
Exactly. DLocal facilitates the transaction, makes it seamless for the merchant and customer, and takes a fee for that connection and integration. But the actual credit risk, the danger of the customer defaulting on their payments, stays entirely with the local BNPL company that extended the credit. DLocal stays firmly in the high-margin, risk-light infrastructure layer.
Okay, this sounds like a really smart model built for a specific complex need. But when you hear payments, you immediately think of the giants, Adyen, Stripe. Why aren't they just crushing DLocal in these markets?
It really comes down to focus and specialization. Adyen and Stripe are incredibly successful, but their core strength, their infrastructure, is built primarily for developed markets, Europe, North America. Stable currencies, established regulations, high card penetration.
Different world.
Completely different. DLocal was born in the complexity of emerging markets. Their whole system is designed from the ground up to handle the fragmented regulations, the weird payment methods, the currency volatility, the specific fraud patterns you see in Latin America, Africa, or Southeast Asia. It's not something easily retrofitted onto a developed market platform.
And DLocal CEO has basically said they're sticking to their knitting, right? Not planning to compete in the US or Europe.
Exactly. They see their niche as the complex global south, and they're doubling down there, which means you often see large global companies using Adyen or Stripe for their developed market operations, but then turning specifically to DLocal when they need to properly localize and scale in emerging economies.
So it's not necessarily either, they can coexist.
For now, yes, often complementing each other. But DLocal's advantage grows stronger over time because of something the sources call the scaled economies shared flywheel. This is really the heart of their competitive moat, why it's like a sticky toll booth.
Okay, break down that flywheel for us. How does being big make them harder to compete with?
It starts with total payment volume, or TPV. As DLocal processes more and more volume, billions of dollars from huge clients like, say, Temu, Uber, Google, Microsoft, they gain immense bargaining power.
With who?
With the local banks and the local payment processors in each country. DLocal can walk into a bank in Brazil or Egypt and say, look, we're bringing you billions in volume from top global merchants. We need better processing fees, better interchange rates than anyone else can get.
And the local banks agree because the volume is so attractive.
Right. And here's the shared part. DLocal doesn't just keep those savings. Their scale allows them to lower their own costs, and they can then pass some of that benefit back to all their merchants in the form of more competitive pricing.
Ah, I see. So the flywheel is more volume, better rates from local banks, lower costs for DLocal ability to offer better pricing to merchants, attracts more merchants and more volume, strengthens negotiating power further.
You got it. It's a virtuous cycle. Once they reach a certain scale in a country, it becomes incredibly difficult for a new competitor, even a big one like Stripe trying to enter, to match them on price because they simply don't have the same volume-based leverage with the local ecosystem.
But couldn't a giant like Stripe just build that volume quickly or acquire local players?
They could try, but that hits the second part of the moat, the operational moat, driven by switching costs. Think about it from the merchant's perspective again. Let's say you're Google, and you've integrated DLocal's single API. It's not just handling payments across maybe 30 emerging markets.
Right, doing more.
It's ensuring your tax reporting is compliant with specific local rules in Chile. It's making sure your customer data handling meets Brazilian privacy laws. It's navigating the KYC Know Your Customer requirements that differ wildly from Nigeria to Indonesia. DLocal is deeply embedded in the compliance workflow.
So ripping out DLocal isn't just swapping one payment processor for another.
Not even close. It would be a massive, costly, and incredibly risky undertaking. You'd need huge internal teams, legal, compliance, engineering, trying to replicate DLocal's connections and knowledge across dozens of complex regulatory environments. The risk of getting something wrong, facing fines, or getting shut down in a market is enormous.
That regulatory complexity they solve is the switching cost.
Exactly. DLocal has spent years building relationships not just with 900 payment methods, but with regulators, tax authorities, local experts. They adapt quickly to rule changes. For a giant multinational, the cost and headache of switching away from that integrated compliance system is often far greater than the fees DLocal charges. They're selling peace of mind as much as payment processing.
Okay, so they have this strong, specialized moat. But the real excitement comes from the sheer size of the market they're targeting. This isn't a small niche. It's a bet on the digitization of the entire global south.
It's huge. The numbers are pretty staggering. The total addressable market, the TAM, for digital payments just in the regions DLocal focuses on is estimated around $2.1 trillion this year.
$2 trillion.
Yeah. And the forecasts, they suggest that could double to something like $4.2 trillion by 2030. The growth rate there just dwarfs what you see in developed economies.
What's driving that explosive growth? Demographics seem key.
Absolutely. Developed countries generally have aging populations, slower growth. Old people tend to spend less. Emerging markets, they typically have much younger populations, growing populations, people entering their prime earning and spending years.
And their economies are growing faster, too.
Significantly faster. Projections are maybe 4% GDP growth annually for emerging markets over the next 5 years, versus maybe 1.5% for the G7 nations. Something like 65% of all global economic growth is expected to come from these emerging economies. DLocal is positioned right in the middle of that growth engine.
And the other huge tailwind is just cash, right? The fact that so much is still done with physical money.
That's probably the single biggest long-term driver, the war on cash. In many of these markets, cash still accounts for 50% or even more of all transactions. Think about that. And financial inclusion is lower credit card penetration might only be 11% across these markets, compared to 65% in the G7.
So every transaction that moves from cash to any form of digital payment is potential volume for DLocal, especially the local methods they specialize in.
Exactly. Every time someone pays their utility bill online with a local bank transfer instead of cash, or uses a mobile money wallet for groceries, that's expanding the pie DLocal operates in. The runway is just massive.
The sources often use this S-curve model to describe how DLocal grows with its clients. Can you walk us through that?
Sure. It illustrates how a merchant's relationship with DLocal typically evolves and deepens over time. Phase 1, a global company might dip its toes in, maybe only enabling basic international credit card payments in the biggest, easiest emerging markets like Brazil or Mexico.
But we know that misses a lot of sales.
Right. So Phase 2 is localization. The merchant realizes they need the local methods to really succeed. They work with DLocal to turn on Pix, Boleto, OXXO, local BNPL options. This significantly boosts their sales in those core markets, and it also increases the volume and revenue DLocal gets from that merchant.
And Phase 3?
Phase 3 is expansion. Once the merchant sees success and gets comfortable with the complexity being managed by DLocal in the big markets, they start using DLocal to expand into the next tier. Maybe Colombia, Argentina, Egypt, Nigeria, Southeast Asia. These frontier markets are often even more complex, making DLocal even more valuable.
So DLocal aims to land the client early and then ride that S-curve up with them, capturing more countries and more payment methods over time.
Precisely. Which leads nicely into the 3 main ways DLocal grows its business. The first is that huge macro trend we just talked about, digital penetration. Simply converting cash users to digital users. That lifts all boats.
Okay, number 1.
Number 2 is share of wallet growth from existing customers. This is often the most predictable and powerful growth driver. It's about getting those current clients to expand into more countries using DLocal and adopting more DLocal services like payouts or maybe the BNPL Fuse product.
And we have a metric for that, right? Net revenue retention, NRR.
Yep.
The latest number was 145%. That sounds incredibly high.
It is phenomenal. 145% NRR means that the cohort of customers DLocal had 1 year ago are, on average, spending 45% more with DLocal today. That's purely organic growth from the existing base before adding any new customers. It shows how sticky the platform is and how much clients rely on it as they expand.
Wow. Okay, so digital penetration, share of wallet, and the third vector.
The third is the more traditional one, acquiring new merchants, winning new global companies, or even fast-growing regional digital players who are just starting their emerging market expansion journey and need DLocal solution.
All right, let's connect this strategy to the actual numbers. The recent Q2 2025 results came out, and despite all the global economic headwinds, the growth seems, well, pretty explosive.
The momentum is definitely there. Let's look at TPV, total payment volume. That hit $9.2 billion in the quarter. Now, that's up 53% compared to the same quarter last year.
Which is already impressive.
Right, but if you strip out the impact of wild currency swings, especially the Argentine peso devaluation, the growth in constant currency was even higher, 65%. That shows the underlying business volume is growing incredibly fast.
And how did that translate to revenue and profit?
Revenue was $256 million, up 50% year over year. Gross profit, which is key, it's their revenue after the direct costs of processing payments hit $99 million, up 42%.
Still very strong growth, even at the gross profit level.
And cash flow.
Free cash flow was $48 million. That's up a huge 156% year over year. It really highlights how efficient the underlying business model could be at generating cash. Okay, strong top line and cash flow. But what about margins? There's been talk about margin pressure. Is that a concern?
It's something to understand, definitely. DLocal is very openly in what they call a heavy software investment cycle. They're hiring aggressively engineers, product developers, compliance experts for new markets. They're building out the next generation of their platform.
And that investment costs money up front, which hits short-term profitability margins.
Exactly. It temporarily pressures the standard EBITDA margin. However, the beauty of their model is the operating leverage. Once the platform is built, adding the next big customer or processing the next $1 billion in volume doesn't cost proportionally as much. Expenses grow much slower than gross profit should over the long run.
So how do we track that leverage if the standard margin is noisy right now?
Management points towards the adjusted EBITDA to gross profit ratio. That metric tells you how much of the actual value they capture, the gross profit, is converted into operating profit after covering their overheads like R&D, sales, and admin. That ratio recently hit 71% in Q2.
71% conversion from gross profit to EBITDA. Is that good? Where is it headed?
It's solid, and importantly, it's been improving after dipping during the peak investment phase. Management has guided that they expect this ratio to climb back towards the 75% mark, or potentially even higher, as these investments mature and the scale benefits really kick in. They're also finding efficiencies, they mention, using AI to handle 70% of customer service tickets now, which slashed response times dramatically.
Okay, that makes sense. But there's another margin metric that seems to be going the wrong way. The gross profit margin itself, or the net take rate, is down to around 1.07% now, from maybe 3% or more a few years ago. Why is that shrinking if they're so strong?
Yeah, that looks counterintuitive, but it's actually an expected part of the strategy, especially when dealing with mega clients. Think about Amazon or Google or Uber. These companies have immense negotiating power because of the sheer volume they bring.
So they squeeze DLocal on the percentage fee.
Constantly. They push for lower take rates. And DLocal is generally willing to accept that lower percentage margin from these giants because the absolute dollar amount of gross profit generated from that massive volume is still huge. Plus, landing these anchor clients helps fuel the entire flywheel we talked about. The scale benefits everyone.
So it's a strategic trade-off. Sacrifice the percentage margin to win massive volume, which drives total gross profit dollars and strengthens the moat.
Precisely. Analysts generally accept this take rate compression as long as the TPV growth stays incredibly strong, which at 50–60% it clearly is. So the absolute gross profit dollar figure is a much more important indicator of health than the take rate percentage itself right now.
Got it. And wrapping up the financials, the balance sheet sounds rock solid.
Absolutely fortress-like. Over $670 million in cash and short-term investments on hand, and critically, zero debt. In these volatile emerging markets, having that kind of cushion and no debt burden is a massive advantage and safety net.
And how are they using that cash? Buybacks? Dividends?
A bit of both, which sparks some debate. They've committed to paying out 30% of their free cash flow as an ongoing dividend, signaling confidence in future earnings. They also completed a $200 million share buyback program. Some investors argue, especially if they believe the stock is undervalued, that all the free cash should go to buybacks right now rather than dividends. But management is balancing returning cash with signaling long-term stability.
Okay, we've covered the strengths, the growth, the financials. But it can't all be smooth sailing. Operating across 40 volatile emerging markets must come with significant risks. What are the big ones?
The most obvious one, and it hits the headlines regularly, is currency volatility. FX risk is just inherent to the business model. When you operate heavily in places like Argentina, Turkey, Nigeria, sharp devaluations are a fact of life.
Like the recent Argentine peso situation.
Exactly. That directly impacts the US dollar value of the revenues and earnings they generate locally. It can make quarterly results look really choppy, even if the underlying business volume in local currency is strong. DLocal actively manages this. They mentioned significantly cutting their Argentine peso bond holdings to reduce exposure, but you can never eliminate it entirely.
Does the diversification help? operating in so many countries.
It does provide a buffer. It's unlikely that all 40-plus currencies will collapse simultaneously. A blow-up in one might be offset by stability or strength elsewhere. But investors just have to accept that reported USD earnings will bounce around due to FX. It comes with the territory.
Okay, FX risk is baked in. What's the next big challenge? The sources mentioned customer concentration frequently.
Yeah, this is arguably the most significant business risk. The fact that 62% of their revenue comes from just their top 10 customers. That's high concentration.
What's the danger there?
Two main things. One, if they were to lose one of those top 10 clients, maybe a giant e-commerce platform decides to build its own solution, or switches providers would have an immediate, devastating impact on revenue and growth, wiping out maybe half a year's progress instantly.
Ouch.
And two, that concentration gives those top 10 clients enormous leverage to constantly push DLocal for better pricing. It directly contributes to that take rate compression we discussed. They know how important they are.
So how does DLocal mitigate that? Are they actively trying to get more smaller clients?
They are. It's a key part of their long-term strategy. They're heavily focused on signing up what they call Tier 2 and Tier 3 merchants, maybe smaller, fast-growing digital companies or regional champions who are earlier in their global expansion. Broadening that customer base is crucial to de-risk the business over time. They're also trying to sell more services like payouts to their existing mid-tier clients to make those relationships stickier and more valuable. But it's a slow process to shift that concentration significantly.
Makes sense. Any other major risks? What about market perception? There was that short report issue a while back.
Right, the reputation and market shocks risk. That short report in 2022 accusing them of accounting irregularities definitely hit the stock hard and created lingering skepticism for some investors.
How has the company addressed that?
The current leadership, particularly the new CEO, Pedro Arnt, has publicly refuted the report's claims, basically saying it lacked real substance. But the incident highlights how vulnerable the stock can be to market sentiment and external shocks. You see these huge swings. The stock might jump 30% on good earnings or fall 20% on bad news or macro fears. It's just a volatile name in a volatile sector.
Okay, so volatility, concentration, reputation. Now, let's look at something that could be a risk or a huge opportunity. Stablecoins. Things like USDC promise near-instant, cheap global settlement. Doesn't that threaten DLocal's whole cross-border FX business?
It's a fascinating dynamic, and yes, on the surface, it looks like a major threat. If a merchant could easily swap local currency for a stablecoin, send it across the blockchain instantly 24/7, and then swap it back to another local currency, potentially bypassing intermediaries like DLocal, that could disrupt their FX revenue stream.
But DLocal seems to be leaning into it.
They are, very strategically. Instead of fighting it, they're aiming to become a critical piece of the stablecoin infrastructure in emerging markets. They want to be the primary on-ramp and off-ramp.
Okay, what does that mean in practice? How would that work?
Think about remittances, money transfers. Let's use the example from the sources. Someone working in the U.S. wants to send money home to family in Vietnam. Today, that might go through slow, expensive bank wires or traditional money transfer operators.
Right.
With stablecoins, the U.S. remittance partner could convert dollars to USDC instantly. The USDC travels across the blockchain in seconds. But then, how does the family in Vietnam actually get usable Vietnamese dong in their local bank account or mobile wallet? That's where DLocal aims to step in.
As the off-ramp.
Exactly. They use their existing Vietnamese dong liquidity pool, their local banking connections, and their regulatory licenses in Vietnam to instantly convert that incoming USDC into local currency for the recipient. They become the essential bridge for the last mile, turning the digital dollar back into usable local cash or bank balance. The same logic applies for on-ramping, helping users in emerging markets convert local currency into stablecoins.
So they're positioning themselves to facilitate the flow between traditional fiat and stablecoins in these complex markets where direct fiat to stablecoin access might be difficult.
That's the stablecoin sandwich idea. DLocal provides the bread, the regulated fiat on-off ramps, while the stablecoin is the filling that travels globally. They're already piloting this with remittance partners, using stablecoins for settlement instead of slow bank wires. They've signed deals with stablecoin issuers.
And the acquisition of AZA Finance fits into this picture too.
Perfectly. AZA Finance, which they're in the process of acquiring, brings a decade of experience specifically using digital currencies and stablecoins to solve payment problems in Africa and Asia regions where DLocal wants to grow, and where stablecoin use is often driven by necessity due to weak traditional finance. AZA knows how to navigate those markets, how to handle settlement gaps over weekends using digital rails. It's a clear signal DLocal sees stablecoins not just as a risk to manage, but as a core part of their future infrastructure offering.
This strategic embrace of new tech, the heavy investment, it all seems to point towards a company in a major growth and transition phase. And a lot of the confidence seems tied to the new leadership, specifically CEO Pedro Arnt. Tell us about him. Why is his arrival seen as such a big deal?
Pedro Arnt he's considered a heavyweight in the Latin American tech scene. He was the CFO at Mercado Libre, ticker MELI, basically the Amazon and PayPal of LATAM roll into one for over 24 years.
24 years. He saw their entire journey.
Pretty much from startup to the giant it is today. He has incredibly deep experience in scaling digital businesses, navigating hypergrowth, dealing with the complexities of finance and regulation across multiple Latin American countries. The market views him as the ideal leader to guide DLocal through its next crucial phase, taking it from, say, a $10 billion potential company to maybe a $50 or $100 billion one, scaling from 10 to 100, as some put it.
What's known about his approach, his philosophy for running DLocal?
Based on his track record and recent comments, it seems to be very focused on two things. First, an intense focus on the customer building the best product, solving their core problems rather than just reacting to competitors. Second, a commitment to long-term investment, even if it pressures short-term earnings. He seems comfortable with the current investment cycle, viewing it as necessary to build durable advantages. He said that success in these digital spaces comes down to execution and product, not just riding macro waves. His credibility is a major asset, especially after the earlier market turbulence.
Okay, so strong leadership, massive market, sticky model. Let's circle back to valuation. The stock has been volatile. Post-IPO hype, then a big drop, now maybe pessimism. How are analysts thinking about the potential return from here?
Well, the bulls argue that the market has swung too far towards pessimism, potentially creating an attractive entry point. There's this idea of an asymmetric risk-reward profile. Meaning the downside might be somewhat cushioned by the strong balance sheet, the moat, and the existing cash flows, while the upside potential is still enormous if they execute well. Some analyst models suggest that if DLocal can keep growing its TPV at, say, a 35% annual clip through 2030, which is actually below their current pace, and get those operating margins stable around that 75% of gross profit mark,
then what could the company be worth?
Those models point to potential valuations in the $15 billion to $20 billion range within that time frame. Compared to its current valuation, that implies a potential compound annual growth rate, or a DGR, for the stock of somewhere between 31% and 39% over the next 5 or so years.
That's obviously very attractive if they can pull it off. It's all about capturing a slice of that $4.2 trillion future TAM.
Exactly. It hinges on execution and continued market share gains within that massive digitizing market.
So, for listeners trying to track this story, what are the absolute key things to watch? Forget the noise. What really matters?
Number one, above all else, is TPV growth. Keep an eye on that total payment volume number every quarter. Is it staying high, ideally above 50% year over year, even if FX makes the dollar revenue look messy? High TTV growth proves the core engine is firing, they're taking share, and the flywheel is spinning.
TPV growth is king. What's number two?
Number two is watching the competitive landscape and diversification. Are they demonstrably winning against Adyen, Stripe, and local players in head-to-head deals in emerging markets? And crucially, are they making progress in reducing that top 10 customer concentration by adding more Tier 2 and Tier 3 clients? Seeing that concentration number gradually come down would significantly de-risk the story.
Got it. TPV growth and diversification away from concentration risk.
If those two things remain strong, the long-term outlook seems really compelling, despite the inherent volatility. We've really seen today how DLocal took this incredibly messy, fragmented landscape across 40-plus countries, the kind of complexity that just scares off most big companies, and turned it into their core strength.
Right, weaponizing complexity through that single API, the local expertise, and this efficient high-leverage model that seems to be navigating even future disruptions like stablecoins pretty effectively.
They've built the digital payment rails, specifically the localized ones, in what is undeniably the fastest growing segment of the global economy, the global south.
So maybe the final thought to leave everyone with is this. We know digital commerce is globalizing. We know emerging markets are where the growth is. DLocal has positioned itself as a key gatekeeper for that growth. The big question then is, how fast will the rest of that 90% of cash transactions still happening in these markets finally shift onto digital rails, like the ones DLocal is busy laying down today? And if that shift accelerates, what does DLocal ultimately become?